Well, good afternoon, good evening, early evening, everybody. Hope everybody's has had a productive day today. Um, and I do want to just echo out that this evening our presenter, Ms. Charmaine Davis, unfortunately had a family emergency and will not be attending with us this evening. So I'm hoping that I can do an adequate job of providing her PowerPoint presentation to you around financial management. In the meantime, I do want to just do some revisiting a couple previous sessions and importance that you spend time beginning to have these discussions internally among your team members. Firstly, for everyone to schedule with Michelle an opportunity where I can sit and talk with you and get to know a little more about what you plan on doing and your strategies going forward and how we as an organization can support the work that you're doing. So I want you to be able to go ahead and schedule those meetings with Michelle so that I can sit down and share in that conversation with you. Secondly, you should have received a cooperative checklist from Michelle, which outlines a checklist of items for your consideration moving forward. First and foremost is developing your business idea. And so if you're at a place right now, you're still pondering on what that cooperative ideal should be like, that's a good space for us to have a conversation around. Because without the idea, there can virtually be no movement forward. So we want to firm up that idea on your checklist. Also, when we looked at marketing, we saw that in demographics and psychographics, there's a lot of research that needs to go on. And so I'm hoping that you are also moving along the pathway of getting some demographic and also some psychographic information regarding your market and what marketing looks like for you in terms of who you're trying to serve, what communities are you trying to benefit, whether your product is going to be or service is going to be one that's going to be met with some receptivity from the audience that you're looking at appealing to. So essentially that you begin to do some research. In your reading material, there are a couple of links for agencies like the Census Bureau and others where you can start to get some data. And even in your local governments, to your planning departments, also have a lot of rich data that you can start utilizing and getting an understanding of what's happening and how to market to your market and the market segmentation that you need to do. The other item on your checklist is whether or not have you sorted out some advice and support? Yes, we're here to support you as much as we can possibly do ourselves, but there are other resources out there in the ecosystem that you need to connect with. So spend some time, again, the videos, the readings are really can be really very, very helpful in this regard in terms of looking at who's out there.
Did Ron freeze on y'all?
Yeah, I think he's frozen.
We are going to be moving down that road of looking at crafting and beginning to craft a business plan for your businesses. Some of you who may be moving around nonprofit work may opt to construct a strategic plan versus a business plan. But a business plan and the strategic plan both serve the same purpose of giving you guidance around where you're trying to go and how to get there. And it's definitely when you start to evaluate what your strengths, your weaknesses, your opportunities and threats are. You've gotten a form from us in terms of just looking at some initial fundraising. And of course, I've said this before, that there are some initial costs that you're going to have to bear as you begin to start out the gate, starting and forming a new business. And so those costs can be minimal to maximum cost, depending on what the activity is. So I think that what I'm advising you to do is to start thinking about how you plan on raising some money. Crowdfunding could be a way to do that. Of course, always friends and family and supporters is another way to do it. Special events, for those of you who've done them. Bake sales, car washes. I know they sound very kind of rudimentary, but they can also be good ways of connecting and raising capital. So begin to think about startup financing and start to put together a budget. It can be a basic budget that you see of costs that you may have as line item costs now that's going to be related to your business. And of course, you can always grow your budget further. But start to put together some thinking around what is going to cost you to operate this entity. Your initial startup costs and the costs that you're going to entail going forward. So we did give you a basic budgetary form, and you'll get a form from us on an operating budget that you can put together for your businesses. Also, too, as you're putting together the revenue side of the operating side of your business, then you want to give some thought to what it would look like on a revenue side. So again, I talked about this fundraising plan, and you want to source out where you're going to start to identify resources. The legal formation of your cooperatives. I just had a conversation with one of your team members early today. So I know that I don't expect many of you to be at this point right now that you've actually said this is the legal formation that I'm looking for this entity. Some of you may be at that point based on your experience and your knowledge base. But for those who aren't, you'll get the chance to go down this road in terms of what am I developing legally when we start talking to the attorneys that will be coming in later on. And not only just a legal form, but also they'll be able to guide you around your governing documents, your bylaws, your articles of incorporation, how you bring members in, when you don't bring members in. And so they'll be able to work with you on the legal forms as well as the governing documents. For those of you who are at a point now, you've made some decisive decisions that you are knowledgeable and ready to move forward on incorporating your businesses, either the LLC or Inc. or a nonprofit, then again, if you are comfortable with what you know, then I certainly suggest that you start to put the entity together on paper. But if you don't know and you're still wavering around knowledge, then put that on hold until we have a chance to talk with the attorneys and get them engaged in help you decide whether or not you register as an LLC or Inc. or some kind of other entity to support your work. Lastly, since you're all are forming cooperatives, I certainly strongly suggest that you give some thought about how you're going to onboard your members. And again, some of this will come as a result of your governing documents, but start to get some thinking about now, how you want to onboard folks. Do you want to have them pay a fee to come on board? Do you want to just give them some opportunity to gain sweat equity in terms of the work you're doing? will it be a phasing in process where they can gain pathways to membership in your cooperative? And so while you may not have all the rudiments around this already thought out, begin to think about it now. And so these are things that you need to think in terms of accelerating as we begin to get through these next weeks ahead of us. So when you look at the fundraising plan, I just want to revisit this again before we go into today's lecture and session, is that, you need to just look at, again, deciphering what your mission is and what your goals are in terms of this work that you're doing, whether you're doing work around food, some intellectual property, some service. Just think through your mission and your goals. And then start to write down a list of folks that you may have as friends or colleagues and supporters that you can target possibly as supporters or investors in what you're trying to do. I mentioned the budget in terms of looking at your expenses and your revenues. For some expenses you may begin to look at now as startup expenses. And then how would you want to fund those expenses through your activity? Pardon me 1 second. Hello, sorry. Hello, I'm in the propaganda right now. Email me, but we can talk later, or just email and I'll respond to you. Eight o'clock. Okay, pardon me, folks. So as I was saying about your monthly expenses and looking at revenue sources, and some of you, from my understanding, may be in an operational mode right now, where you may be incurring some expenses. And so you want to be able to make note of that in a budget, what your expenses are and what your revenue sources are. And so we'll send you something that you can start to put those numbers in place. And then most importantly is what goals are you setting around fundraising? And so these are all the things that you want to be able to think through now, because they will come up later at some point in time as you continue along this process. All right, so you have a checklist, and we'll get a chance to go through that checklist with you as well. And the other discussion I want to have this afternoon, and I know I'm laying a lot on your plates, but I want you all to have this as food for thought going forward. It's how you're building out your ecosystem. How you're beginning to build out your ecosystem in terms of folks or organizations that you want to collaborate with, and you see some collective synergy around. I was just talking with a group in Baltimore that has a product out there on the line they've been doing for the last couple of years, and they've been doing pretty well with it. But of course, as a result of this pandemic, a lot of their sales slowed down. And so one of the things in talking with them today that came up out of the conversation is that they had not really built a lot of relationship to support their work and support that they could market their product to. So I shared with them this thought that for them in this product mode, they needed to expand their territory in terms of looking at more relationships. So they're doing edible, and so I'm saying that there are a lot of grocery stores, a lot of co-op markets being developed across the country. They need to find out who those folks are, so they can, have them experience their product. And of course, if they experience it and enjoy it, they may choose to put it on their shelves. But it doesn't do them any good to have a good product that they're not marketing out there to the general public and building that relationship out there in the ecosystem. So For those of you who are looking at moving this work beyond the point of just having your own internal conversations, look out beyond your horizon to see who else can you connect with out there that's aligned with the work that you're doing. Some of that alignment may come locally, may come regionally, and some may come nationally. But I'm quite sure if you do the homework, you're going to find folks out there who are also supporting your work in many ways as well. Okay, so that ecosystem, folks, is really important, and not to get siloed in thinking that maybe that you're the only person with this idea, or that there may not be a receptivity to your idea. And so I'll send you something where we're going to talk about that ecosystem, because I think that's really the impetus of growth, where you can develop a strong ecosystem that supports your work, and you're able to connect with it on a regular basis. So what we've seen, and I want to read an article that was published a couple of years ago, that more U.S. businesses are becoming worker co-ops. And really, because now we're finding that there are new tools out there in the political landscape that are promoting more cooperatively owned business, more worker solidarity businesses. And I think that's what probably some of the work that we've seen, or some of the conversation we're hearing about people not wanting to go back into the old traditional jobs that they had previously to the pandemic. But people are looking for new opportunities, more exciting opportunities, and of course, better wages and working conditions. So that is the good thing that you bring to the table as a cooperative, is that you're going to be very mindful about wages. So you're not there to exploit, you're there to help people grow. And as you bring them along in this journey of growth, you also build solidarity with those folks who become engaged in your cooperative. And so one of the things that we did see during this whole pandemic was that cooperatives did very, very well versus the traditional capitalistic businesses that were more capitalistic oriented versus human oriented. And so the cooperatives did very, very well in terms of workers who made commitments to keep their cooperatives intact. And so they made sacrifices on salary and other work concessions to keep the work moving forward. And so that's one of the good things about working in a cooperative, because you do bring people there and engage that not only are looking for, yes, good salaries, but also some importance around what they're doing. So I wanted just to revisit all of that this afternoon before we got started in the session. Any comments? You can mute your mic and share your thoughts, because I'm here to learn too. Are you finding that conversation around ecosystems relevant to what you're trying to do, and the importance of growing your ecosystem in terms of not just within your own organization, but to help grow the ecosystem that's external to you as well?
Yeah, absolutely. For the efforts we're trying to do in DC, that's exactly what we're attempting to create, is an ecosystem network of caregivers that are entrepreneurial and are creating solutions for families of children with disabilities. So, I mean, how we go about it is extremely important. So actually being architects of a different kind of system of care, and, hopefully not so underground, but a different path to services. That's exactly what we're building. So I'm very excited to learn, the cooperative model, because I think it offers so much to what we're attempting to build here in DC.
Mm-hmm, mm-hmm. Yeah, and there's some ecosystems out there that are very strong. Sienna and her group in West Baltimore is working in the food space, And we're seeing a lot of lift from food co-ops. Those are doing urban farming, those are doing rural farming. We're seeing a lot of lift. And at our upcoming conference, we're gonna be having a conversation around farming. And we're seeing even some federal policies that are shifting now around farming, giving more resources back to Black urban rural farmers in terms of some of the land and other. Cory Booker has a piece that he's been promoting in terms of reparation for farmers. And certainly we know in the urban environment, our urban farmers did so well. And I just applaud the work they did last year with getting food out to people who were obviously shut out from getting healthy food because of the pandemic and the production drop that took place nationwide. It was our urban farmers that kept people fed. And so so that ecosystem has been growing. And so with that said, it can be also the impetus for growing how to grow other ecosystems around this work that we're doing. Because as I said earlier, the first time, any business can be a cooperative business. It's just a matter of how you want to form it, how you want to govern it, how you want to organize it. But any business can be a cooperative business. Any idea can be a cooperative idea. And so, so again, just showing that that pathway that that the opportunities are really are before you to grow your entities in a way that's meaningful and productive for others to get engaged, because that's what you want to be able to do at the end of the day. You want to for people to look at what you're doing and say, I want to be a part of it. I mean, that's the end of the, to me, that's the ultimate. That people look at what you're doing and say, I want to be a part of it. People look at what you're doing and say it's a benefit. And then take the upsides of all the work that you're doing right now, and they want to lift that work up in terms of supporting your cooperatives and your ideas about what it means to work in a solidarity environment, what it means to work in communities that are needing so much. So okay. So again, I just want to make a reference to the grant. I don't think I've gotten any applications thus far, but over these next weeks, as you sit down and work through with your teams in terms of what your needs are, I'm hoping that you will look at this micro grant opportunity as a way of fulfilling some of the needs that you may have to get you started, or to actually build more intentionality around the work that you're doing. Okay? All right, well, good. Well, we're gonna get started. Um, Again, you'll get a chance to interact with Charmaine Davis, who's a certified CPA. She works in out of the Baltimore region, but she works regionally in terms of working with small businesses. And she's been in one of our regular presenters here in our academy. So unfortunately, she, again, as I said earlier, she had a family emergency that came up, which precipitated her not being with us today. But I hope that I can do some justice to her presentation, talking about financials. So Michelle, with all that said, can we get started?
Yeah, just enable screen sharing first.
Oh, whoop, that's something I gotta do, right? Okay. Okay, multiple participants. Thank you. Okay. Okay. Again, Charmaine Davis is a certified CPA, certified public accountant. And she works for a group called the Hartford Business Center in Baltimore. And that group, again, does a lot of work around small businesses, supporting them not only through their financial needs, but also through their business needs as well. And so you'll get a chance to talk with Ms. Davis and hear from her directly in terms of her experience working with small businesses. And she's been also engaged with a lot of our upcoming upstarted co-ops over the last year or two. So first slide, Michelle. Okay, so the basic fundamentals of accounting is this here. Assets equal liability plus equity. Assets equal liabilities plus equity. Does anybody know what liabilities are? Anybody wants to define what liabilities are? Okay. Well, liabilities, folks, are what you owe. Just simply what you owe. And so as you start to build out your financial picture, I stated earlier about revenue and expenses. And your expenses essentially in your budget become your liabilities. Whether they're your office space, whether they're paying for utilities, whether they're paying for staff salaries, staff benefits. If you're renting a space and you're either paying mortgage or lease on it, those become your liabilities. Loans that you might have borrowed on, and the repayment of those loans, they become your liabilities. Now, what are your equities? What is the equity? Well, equity is what you own. That's what you bring to the table. It may be your initial investment in a co-op to get it started financially, or in some cases, and I think I heard this from Sienna, in terms of you can have equity in terms of your time. The time that you put in is a part of equity as well. So I know that in some housing groups, they help homeowners become homeowners through what they call sweat equity programs. That means the homeowner would have to contribute a certain amount of hours to helping to build their homes. And this model is even incorporated, I know, within some of the farming communities where people come in, help farm the land, and as a part of farming the land, they get the benefit of the produce that comes out of that. But they have to put their equity into helping to grow. All right. So, okay, someone's there? Okay, so assets equal liabilities plus your equity. That's your assets. What you own, what you owe, and what you own. All right, next slide. So, you might have heard this term about balance sheet. And what is a balance sheet? Well, a balance sheet tells your financial story in a particular point in time. It looks at all your assets. It looks at all your liabilities. And it takes into account what equity you may have as a result of that. But your balance sheet is a point in time. And so why does the balance sheet become important in this discourse around financing? Because when you start looking at going after financing and looking at lenders, they're gonna ask this question here: what does your balance sheet look like? And again, the balance sheet is showing your assets that are equal to your liabilities plus your equity. And so if your balance sheet is showing positive, then you're going to show some equity there through your balance sheet, right? Because again, your liabilities are lesser than your revenues and your equity. But when your liabilities become more than your equity and your equity, then you're operating in the red. And so you want to be mindful of this from the early start, that as you start to set up your financial books and your financial ledgers, that you certainly take in consideration that everything that you will be doing will be constructed around creating a good balance sheet. So that when someone asks you, what does your balance sheet look like, that you're able to interpret it. You'll be able to tell the story of what your liabilities are and what your equity is. And so you'll have that story to tell. But the balance sheet is in terms of its importance, is critical to telling the financial story of any organization in a point in time. Again, in a point in time, because your balance sheet's changing. As you make loans and you pay down on the debt, that changes on your balance sheet. As you bring more equity into the organization, it changes on your balance sheet. That's why it's a point in time activity. So your balance sheet could in January could look one way, and then in March it could look another way, depending on your liabilities and the equity that you are recording on your balance sheet. Next slide. Okay. So here we have an example of some assets that go on a balance sheet. Examples for assets are cash. As they say, cash is king. Accounts receivable. That may be payments that are owed to you for services you may have rented or products that you have sold. Prepaid expenses. Inventory that you're housing. Investments, if you have real estate or other investments. Maybe a loan that you've made to someone that's paying back to you. That's an investment. If you're owning land or buildings, those are assets. And of course, your furniture and equipment. Those are considered examples of assets that go on your balance sheet. And on the other side of that balance sheet, from assets, we have liabilities. So accounts payable, who do you owe money to? Accrued payroll, that occurs when you're paying your staff, but you're not paying them in a moment of time, but you're paying them on projected salaries earned. So you accrue them on your books as payroll. So I accrue them this week, but I pay you next week. Deferred revenue. That could come in a lot of ways. Maybe you owe some property, and maybe in January you get a windfall from revenue, maybe a tax abatement or something that comes as a result of that property. That's deferred, which means not paid in this moment, but it's looked out over a period of time. Accrued interest. Well, in your looking at loans, you accrue interest in your loans, and sometimes it's compound interest, and sometimes it's the monthly interest that you may pay. And so interest you pay on loans and other assets, maybe some of this furniture and equipment that you purchased it on a program where you're paying interest on that. Member deposits. If you have members of a co-op and they're required to pay membership into the co-op, then you count that as an asset in terms of one of the liabilities. And of course, other liabilities could be loans payable as well, loans that you pay out. And so, all right. So the members deposit, I just want to just preface that, because members can deposit membership fees into the co-op, and maybe 5 years, 6 years after, based on some accrued interest, they're able to draw down on what they may have paid into the co-op as a membership deposit. But for you as accounting, you don't keep that as a liability, because eventually that's some money that you will have to pay out when that member leaves, or the maturity period may arise around their deposits. So here's two examples of assets and liabilities and how they go on your balance sheet. Now, the question I would ask at this point in time now, is anybody keeping an accounting of any revenue or liabilities that are coming into your entities right now?
Yes.
Valerie, go ahead.
I am keeping a ledger, and it's kind of pretty basic, but it's on an Excel spreadsheet of the expenses that I've or my liabilities, and then also different assets, like from different events that I've hosted, or classes that I've hosted and things like that.
Okay, all right. So Valerie, let me get clear. This is, you said something that you're hosting. Is this under an entity, or this is your something that you're doing personally as business?
Can you say your question one more time?
Is this bookkeeping, this revenue and these liabilities, that these assets and liabilities that you're accruing right now, are they directly related to you as an individual, or are they related to an entity that you are a form or a part of?
Right, related to an entity, Priority One Wellness.
Okay, then. Okay.
Mhm.
All right. All right. I saw Sienna shaking her head too, down at the bottom. Yes.
Yeah, we
Go
have
ahead.
our market manager Shanti actually helps keep the books. So
Okay, then. Okay. All right. Well, good, good. And I will say this, folks, just for my experiences, the importance of financial controls and record keeping. If anything we've learned is that most organizations and most businesses, when they fail at this point here of keeping good financial record keeping, is when they fail as a business. This opens doors for anyone to come at you around your level of accountability and responsibility. And particularly when you're talking about grant funds and funders are giving you monies to do certain activity. At some point in time, they want to see a level of accountability that you are a good manager of those funds. And I've seen over my years groups that have not done a real good job at being good fiduciaries over their funds that they receive from grantors. So keep in mind that you want to be able to document this here. And even if you don't have a bookkeeper on board right now, begin to ledger, even on a notepad, you know, what money you're getting in and where that money is going to. And for those of you who may be using fiduciary agents or fiscal agents to manage your funds, make sure, again, I'll emphasize this, make sure you know how the record keeping is taking place as regards to your organization funds. All right. So next slide, Michelle. So equity. You know, equity can come in a lot of ways, and retained earnings is, does anyone know what retained earnings is before I describe it? Okay, well, retained earnings could certainly be that, but if you got a business that's maybe nonprofit or even profit oriented, and you earn revenue over the last year, and so you retain those earnings, and you can redistribute those earnings out based on your bylaws and your governing documents out to your membership, out to your shareholders. And so for those of you who are members of credit unions, you get some of this back in terms of retained earnings. So at the end of the year, when your credit union has profited, you know, they may give you a share check back, or they may give it back to you in some form of a member's benefit. But that's the equity they earn, and they retain those earnings, and then redistribute those earnings back out to the members in terms of shares, certificates, or capital contributions. So as you, again, look at incentivizing participation in your cooperatives, you might want to consider, how do you use your return earnings as an incentive for your membership? Do you give it back to them in shares? Do you give them a certificate? Or maybe make it a capital contribution? Or sometimes, again, depending on your organization, you may use that return earnings to write down debt. Again, it depends on how you structure your governing documents in terms of equity and how equity is used, that's earned by the cooperative. Next slide, Michelle. The income statement. Well, very simply put, again, looking at a period of time in terms of what your organization has been able to amass in terms of income, in terms of financial performance. Next slide. Okay, here's an example of income and expenses. Okay, income could very well be your cooperative members' charges and their assessments. Fines, if you have fines that you attach to members for maybe missing meetings, maybe some other infraction that you have stipulated in your governance documents. It could come by way of income as membership dues. What does it cost me right now to be a member of this organization? Are any of you right now involved in an organization where you're paying membership dues? I know Julian is. Yeah. Huh? Yeah. Well, you'll find it to be true that when you start to expand, particularly when I talk about your ecosystem, you're going to be paying membership dues. I know Julian paid dues to be part of many organizations, bar associations, all these other legal groups that he's a part of, and you pay into those membership because you want to first of all have the credibility that comes with it, right? When you say I'm a member, I'm a paid member of an organization, it gives you sort of a little credibility nudge around, people recognizing who you are. But then there's a membership that you want to pay when you just want to be able to access information. And it requires that you be a member to be able to do that. So again, membership dues are a part of, can be a part of your income. I know that for us, we have membership dues for our nonprofit, for those who feel like the work that we're doing is important and they want to galvanize around that work and they want to benefit from events that we do. There's a discount for members versus non-members. Okay, interest and investment income. Again, if you're owning property, you're leasing property, there's benefits that come as a result of that from you being the owner. That revenue, again, is self-generating based on your interest of your property ownership. And so you can use that as income generating as well. On the other side of expenses, well, these are some examples, and you can outline many more. Maintenance and repairs. If you own vehicles or buildings, of course, there's maintenance and repairs that go to those buildings. As I said earlier about staff salary and wages, staff benefits, depreciation can become an expense as well. Depreciation on your office equipment, on your building, vehicles that you may own, utilities that you pay, your gas, your electricity, again, interest on any other loans that you may have accrued, that that require payment, your insurances, which you certainly, as you grow the organization, you're going to get board indemnification insurance, you'll get hazard insurance, because you want to make sure that you are properly legally insured to do business. Now, we're in a very litigation prompted society now. People will sue you over anything. So keep in mind that as the board of directors, as we talked about yesterday in terms of governance, you are legally responsible for every action of your organization. It's not the staff, it's the board. So you want to make sure that, going forward, that you've done your homework and your investigation and you got the proper insurances going forward. Just in case someone slips in front of your building or inside of your building, or some inappropriate maybe behavior on the behalf of one of your staff persons. So you want to make sure that you have the right type of assurances going forward. Professional services, if you hire out consultants to do work on your behalf, whether you're doing graphic design or maybe doing any other kind of work that's relative to your needing your services done, that's an expense. Those people want to be paid and they want to be paid in a timely way. The other two items are supplies, of course, managing and using paper clips, notepads, and all the other things that we use in terms of being to support our work. There's expense attached to that, as well as any ongoing training that you may seek out as part of your professional development. And so these are some items that when you want to start looking at putting together your expenses and revenues, that you want to be able to look at in terms of your initial budget. And again, those budgets are relative to the businesses that you are operating, because every business is different. My budget for operating a farm would be much different than operating a legal firm. And so would be many of my expenses. All right, because in farming you need tools, you need machinery, and you wouldn't, some of those items you would not need in other types of businesses. So start giving some thinking, folks, to that budget, and what that really means. Because at the end of the day, as this arrow was showing, you want to see your revenue go up. That's the key. You want to increase your revenue and control your expenses. This is how you balance your budget. So we've heard that term numerous times over the years regarding our country in having a balanced budget. So when your expenses exceed your income, your budget is out of whack. It's unbalanced. So you want to balance your income with your expenses at the very least. But in an optimum way, you want to have more revenue always than more expenses. Let's go to the next slide, Michelle. So here's an example of a balance sheet. We're seeing assets in terms of the cash, accounts receivable, restricted income. And so from some of us who are in the nonprofit world, we know we get restricted grants from grantors that only allow us to use those grants for certain activities, right? Then, of course, we own land at 20,000 and we own a building. So on this balance sheet, the assets are $147,000. So on the other side of this balance sheet, we look at the liabilities. We see that there's accounts payable for 3,000, loans payable for 80, members deposits, and the total liabilities is 93,000, and return earnings that we discussed earlier is 54. So here we're seeing a balance balance sheet, but also a balanced organization in terms of the budget, their assets and their liabilities. So again, as you set it down, thinking through your budget, keep in mind, your expenses, keep in mind in terms of your revenue. And if you're owning things now that you can look at in terms of some liabilities or even some assets, to make sure you make note of those as well. And so my biggest advice to you at this junction, as I talked about, balance, if you don't have those skill sets in place, start to identify someone that has knowledge of how to set up some basic ledgers with a chart of accounts that you can start to monitor and report back on. Because keep in mind, this is one of the responsibilities of the board of directors, to provide reports and to monitor the activity of the organization. So all this, what we've now have talked about to date, it starts to really come in and really frame about, governance, leadership, what's required. All those conversations now come into play when we start talking about growing and documenting ourselves fiscally. Next sheet, Michelle, income statements. All right. Again, going back, looking at your revenue and your expenses on the income statement. So your revenue in this column here to your left looks at your member assessments, and those could be membership dues. They could be things that you've written in your bylaws that are responsibility or passed on to your membership as revenue generators. Of course, the interest or income could come from your deposits and what interest you get based on the amount of deposit that you have in a banking interest-bearing account, and it shows up as a total revenue, that membership assessment, as well as the interest income, which is total revenue of $131,000. Here on the other side, when we look at the expenses, look at the loans, interest that you're paying out, your utilities, any depreciation as a result of property or equipment that you may own, maintenance on property or equipment. Again, education could be self-development, training that staff are going through. And so they'll all be expenses on your expense budget. And the total expenses were 127 versus the total revenue, which is 131. And our net income, keep in mind this word net income, was $4,000, which is your total expenses minus your total revenue. You get your net income. And if this had been reversed, 131 in terms of expenses versus 127 in revenue, this would have been a minus $4,000. And we come to understand that means that we're in the red. And none of us ever want to see our businesses in the red, because that's not a healthy place to be when we're owing more than we're taking in terms of revenue. Does someone want to say something?
Yeah, this is Julian. Quick question. Are we going to talk about cash flow statements, or are those typically done like later?
I think Miss, and I haven't gone through all of it. I think we touched on a little bit, but she'll be covering that in her second part of her presentation.
Perfect, thanks.
Thank you. Keep going, Michelle. Okay, a retained earnings statement, which again is another ledger, chart of accounts that you keep in your chart of accounts. Now, what are chart of accounts? You're going to have a chart of accounts for every expense item that you're logging in your ledger. There'll be a chart of accounts for education. There'd be a chart of accounts for utilities. There'd be a chart of accounts for member payouts. So you'll be, and this is something that you'll get done through a certified bookkeeper or someone who's knowledgeable about bookkeeping, or a CPA in terms of helping you set up your books. That's what we call setting up your books. So this retained earnings statement here is beginning return earnings of $50,000. That's what we started with. That's what we've started with. And so we've generated another net income, because this could be other people contributing another 4,000. So at the end of our recording period, we've retained earnings of $54,000. And so in a micro conversation, what would that be right now if you were setting a fundraising plan? Well, your return, if you have 5 members right now, and say each of you contribute $5 a week, and so that's 4 weeks in a month, that's $20 from the 5 of us, that would be $100. Right now, we would have in terms of return earnings. And if we recruited some other people as a result of that, then their income will come under the net income. And so we will generate another line item income here. And then, of course, adding those 2 items together, we get to our ending return earnings. So yes. And so if you're looking at, right now your fundraising plans and how you're going to raise capital, you can start to raise monies right now by asking folks to invest. And you may want to, look at what that investment may look like, whether you're going to pay them a dividend on the investment, or you're just asking them to contribute as an investment with no repayment attached to it. I think we do a lot of that now through crowdfunding, having to raise capital. Next slide, Michelle. Okay. And again, at the end of the year, the net income flows into retained earnings. So net income, again, begins on a balance sheet, and then we add that to the net income on our income statement, and then our retained earnings at the end of the sheet, all that goes again back on our balance sheet. So again, being very, 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 very mindful of how our revenue and expenses are being recorded. I'm not a CPA, but I am familiar with the GAAP, Generally Accepted Accounting Principles rules. I have gone through audits. And so there's a general rule in terms of how your books should be established based on generally accepted accounting principles. But then there's some folks who operate on a cash basis, which ledgers look a little different as opposed to the general accepted accounting principles. So you may have some ledgers in your cash ledgers that may not be needed in your GAAP ledgers. But again, that's something that a accountant could show you or share with you, because some folks do operate on cash accrual principles, and some operate on a general accepted accounting principle. So there are 2 separate ways of methods of accounting. Okay. Next slide, Michelle. So let's take a look at the GAAP method, also known as the accrual method. It is used for most formal financial reports, such as audits. And if you've not gone through an audit, let me just share with you my experience of going through audit. Um, Thank you. Thank you. Go ahead, Joe. Take your cereal fast, man. Hold for 1 second. Thank you all for bearing with me. I had to get my son up to another part of the house. He's wandering around, and so I didn't want him to be a distraction for you. So getting back to what I was going to try to explain here in terms of the accrual method. And it's used by most financial reporting methods. So that means that when you're doing accrual, it's looking actually at the revenue that's actually earned. The revenue that's earned and expenses when they actually incur. So what that means that say today someone gave me a check of $100,000. Well, I've not expended the $100,000 today, but I recorded it today. So what happens 30 days from now? I've accrued some expenses that I expended out of that 100,000. So those expenses will be deducted out of that 100,000 that was given to me 30 days prior, but 30 days later, I'm now spending it. That's the accrual method. Again, recognizing income when it's actually earned and the expenses when they actually occurred. Because most of your expenses will probably be billable on a 30-day billing cycle. So when you incur a service, most likely you're not going to be paying for that service at that particular day and time. They usually give you a 30-day window to pay for the service or a product that you might have purchased. But you've earned the income that you are paying out that expense that you earned that in previous days. So when you're looking at the accrual method, it's based on the revenue that you generate right now, and then expenses that you will pay out later. And so that really gives you a real true economic picture of where you are in terms of being able to balance your budget. So when your accountant comes in and looks at the revenue, he'll look at what had came in, but then he'll also be able to look at what you've paid out in terms of all your expenses. So that is the GAAP method of accounting. And so,
Ryan, can I ask a clarifying question?
Go ahead.
So just so I'm clear, so accounts receivable and accounts payable. For receivable, right? Like that's not actually in your bank account. And so with those under GAAP, would those still be considered earned or not? I don't know if that makes sense.
Well, receivable is still revenue. And it's something that you're billing for. You've already provided a service and now you're billing for it, right? So say you do some consulting.
Gotcha. Okay. No, yeah, I'm clear.
Yeah, you give me.
I haven't paid it yet.
That's receivable. That's right. That's your receivable. But you're going to log it in revenue. It's just going to be paid in at a certain point in time. So it moves from being a receivable to a payable. So that's how your accountant would log that entry from being a receivable to being a payable. All right. So let's go to the next slide, Michelle. The CAF method is just simple and straightforward, and it's about what I get in and what I pay out. Just simple as that. That's CAF method. I get it, I pay for it. And most folks don't operate on a, pardon me, 1 second, goodness. I thought everybody got the memo that I'm in academy from 5 to 8. I guess everybody didn't get it. My apologies. But anyway, looking at the cash method, it's really just looking at your budget, and once I get it, I pay it. I don't let it accrue over no 30-day or 40-day period. I just go ahead and pay it. And so that's how cash is handled usually in the cash method. I know very few folks who actually do the CAP method. Most of the organizations that I've been familiar with usually operate on the accrual method of accounting. But again, there are some who probably still do operate on the cash method. And if you're probably working, particularly when you talk about sales, like barbershops, hair salons, they all are cash businesses, and most of them do operate on the cash received and paying out what they need to pay out at that point in time. So if they're renting the barber chair or the hair salon chair, and as they're collecting money from their patrons, they're paying right out of their pocket, probably paying to the person who they're renting the chair for. That's probably the simplest example I could point to in terms of a cash method of paying. Next slide. Depreciation. Well, this is we're going to have a tax attorney that's certainly going to come and share with us, because a lot has changed in terms of tax codes, particularly in terms of what we can appreciate. That was a part of the tax changes under the Trump administration. And so at this point in time, I certainly, even my own personal tax, the things that we used to appreciate, we can no longer appreciate now. So you're gonna need some real tax advisement for your cooperative in terms of what is appreciable and how long can you appreciate it. One time it was 22.5 years you could appreciate, but I do believe here hence they have limited that from 22.5 years, I think 27.5 under the Trump administration. But this is something, again, a tax attorney can guide you in understanding and structuring on your books in terms of what are depreciable assets that you need to write off, and what things you cannot write off. I think one of the things I was certainly aware of that you can write off one time, work uniforms and things of this nature. I think those things are no longer allowed under this current tax code in terms of things that you're able to depreciate, work uniforms and things of that nature, mileage on your car. I know that is one of them that you're not able to appreciate anymore. But again, this is where the knowledge of an informed tax accountant comes into play. Next slide. Okay, maintenance projects. So per the gap method, you're going to capitalize and then depreciate major projects. And so let's talk about capitalization and depreciation. say that you have an air conditioning unit that's gone bad and you've had to replace it. So you capitalize it on your balance sheet as a new fixture. And then you begin to depreciate it, its useful life on your balance sheet as you go forward. So each year you depreciate that purchase that you've made on your balance sheet. All right. So that's where the capitalization comes in and the depreciation. So if you're in a business that you may be using what kind of, other than furniture, maybe a car, maybe it is a vehicle attached to the business. So now your old car has gone bad, you bought a new truck for the business, and how do you appreciate that on your balance sheet? Again, this is a very sensitive area that I would certainly recommend going to a CPA to work through this through in terms of what you're capitalizing and what you're depreciating as a part of your equipment and purchases for your business, particularly around things that require maintenance. That may be old office equipment, etc. Okay. So it says here also to during the gap, we expense minor projects and record them on the income statement as maintenance expense. And those minor projects could be having someone just to come in and service your copier, someone to service your phone system. And so those are maintenance expenses to those items, and you expense them as minor repair on projects. And of course, under the cash basis, all maintenance projects are usually will be expensed under the cash basis. So the difference between the cash basis and the per gap basis is that you capitalize, then depreciate under GAAP. Under cash, you just expense. So depending how your books are set up by your accountant or bookkeeper, which of these two systems are you going to be using? I would say that for, again, as I said earlier, most of the groups are using the GAAP measure because at some point, while you may not be required to do an audit report, in the case that you may be audited, you want to show, again, a balance sheet where you have your expenses, your revenue, and how you're depreciating items on your balance sheet. Certainly recommend, again, next slide, Michelle, that you don't try to do some basic things you can do your own, but really, it really comes down to having skilled persons supporting your work to do that.
Oh, and Patrick raised his hand. I think he might have a question.
Go ahead.
Yeah, I was just another clarifying question. In terms of rent, isn't, if you're paying rent and don't own the building, that's not an asset, it's just a delta?
Liability.
Okay, just confirm. All right, thank you.
Now, let me ask you a question, Patrick. Why is it a liability?
Because you don't really have any equity in it to build value.
But and then it's a liability because you call it, what is it now? It's rent, it's called what?
Say that again?
It's rent. You rent, you're paying leasehold, right?
Yep.
And what is it normally called?
I know, money
On
going out.
On your balance sheet, you have revenue and what else? Expenses.
Liability?
Expenses.
Expenses, yeah, it's expense.
Yeah, it's expense.
Yep. But so it's a little bit, it's not confusing, but I can just imagine a time where you buy a building for a lot of money and then it's going to be an asset because you haven't begun to depreciate it.
That's right.
But then your cash flow is going to be messed up because you don't actually have cash in hand. And I guess that's when you look at the other reports, right?
Well, keep it, let's go down, let's have a little discussion on that. You said you own a building,
Or
right?
you buy, yeah,
You purchased a building through a mortgage, right? I'm assuming that you own debt on the building, right?
yeah, because I
Okay,
get a
so-
mortgage.
So the mortgage payment itself becomes what?
Asset.
Well, the building becomes an asset. The mortgage payment becomes a liability, right?
Yeah, but look, so let me think about this. So like if I have a mortgage, right? Every time I pay the mortgage, I earn a percent of equity in the
In the
building.
building, right, on the other side of the balance sheet, right?
Okay.
Because once you start paying down that debt, you're increasing what? Your equity,
Yeah.
right? Right. But but say that you own the building and you're leasing out portions of the building, then that becomes income, doesn't it?
Yeah.
Okay. Yeah. So let me just talk about this budget variance, because I want you to follow me here. In 2021, we're doing a budget in 2021. So we have revenue, expenses for 2021. So if we look at 2020, the year prior to, we get a sense of what those expenses and revenues were, particularly the expenses in the previous year. So one of the things you want to be able to do is to do projections, forecasting on your budgets. And so for all of you who are starting new organizations, you would have probably little or no data to be doing forecasting. But for those of you who may have had data in the previous year in terms of financial data, then you can look at forecasting. You see the difference of what you spent last year versus this year. And that difference is the variance. So say that in 2020, I spent $2,000 on a copier. And in 2021, I didn't spend $2,000, but I might have budgeted another, say $4,000 for copier. So the difference in 2021 would be $2,000. That's my variance. Because it's looking at the previous year of expenses versus what I'm projecting now and what that variance will be going forward. All right? Because 2021 is, your budget of 2021 is only a projection, it's not actual. So, but when you do your projection against your actual, then you'll get your variance. Let me repeat that again. When you're constructing your budget and you put together a projected budget versus what you actually expended, that will become your variance. Your variance. Let me know if you're clear on that. Your projected minus your actual is your variance, which could be positive or negative. So for all of you who are now putting together a budget, this is your projected budget. It's not an actual, because until you actually have expended money on that line item, then it becomes a real number. So if you budgeted $2,000 for a copier and say that you only spent $1,500, your variance would have been $500 plus $500, right? Because you saved yourself $500. Even though I budgeted $2,000, I only spent $1,500, so my budget says plus $500 is the variance. And so when you start doing your budget and your forecasting, you want to make sure that you incorporate a variance item from your projected to your actual, so that you can see how you're fluctuating in terms of your budget, whether you're moving in the red or moving in the black. All right,
Ooh, one more question.
go ahead.
All right, I'm gonna stop after this one because
That's all right. No, don't stop. Don't stop. Please don't stop. Go ahead.
Sienna hasn't said anything, and I'm like, anyway. So,
And she's a financial whiz, man. She knew Sienna's a financial whiz.
all right, so I know, and I don't know if it's because they just gave voiceover to the income statements and all these things, but there's times where they're like, these are one-time expenses, and then so when they're presenting it, it looks good, or it doesn't matter how much you're spending because they're like, this is a one-time spend, kind of like with the because we're starting up, kind of. And then
Okay.
so when they look at our space on the sheets, it's like either do you give voiceover to that, or is there a way to construct it in those documents so that it makes your position look better?
Well, keep in
So for
mind.
example, I'll give you, there was a corporation, hypothetically, you worked for a corporation, they were rebranding, and the way we took the money out of the corporation, it was like we spent a lot that year because we knew we were rebranding, and we said it was like one-time expensive, but the overall look of the business, we're like, it's still in good shape.
You took money out of the business to rebrand the business.
Yeah.
Mm-hmm. Okay. And so the question becomes, did you expense that, right, as a line item?
Yeah,
Whether it's called new branding or whatever, you made it an expense.
I did. Yes.
Okay. So yeah, so it became an expense on your budget.
Okay.
That's what it became.
All right.
Now the question, and I'm trying to get to the question here, is this around variance or the fact of how you recorded that expenditure?
So like if someone, I'm guessing like, so the correlation I'm trying to make are to see like if you're new starting your cooperative, right, there's going to be expenses that you won't occur later in your operation.
The actual, that's why you're putting together your projected budget.
Okay.
Because these now become actual expenditures. Say that my projected budget is $1,500.
Okay.
And I'm gonna use that whole $1,500 as for marketing.
Mm-hmm.
As a one-time expense, I've exhausted that line item.
Okay.
All right. So this is again, this is the moment in time. I have the money. I'm expending for the service. So if I exhausted that budget, that line item budget, is that what correctly? Right? I projected $1,500 for marketing. I spent $1,500 for marketing. So my budget right now is zero. There's no variance to that.
Okay.
All right. Now, if I had increased the budget even after expended it, then I may move new money into that line item. Then I've increased the budget from $1,500 to maybe $2,000, but I've only expended $1,500. I got another $500 I do have left to spend.
Okay.
That's why tracking the budget is really important. I'm glad you're bringing it up, Patrick, because you got to be able to track those projected versus those actuals, and if there are any reserves that you may have left over. But once you've exhausted the line item, there are no reserves. Then it's what I call realigning the budget, and that's another process that as you go through doing your budget, you're going to always be able to take a snapshot in time at your budget in terms of how you're moving dollars.
Mm-hmm.
Yeah, particularly when you're starting up, because you'll find yourself with some expenses that may cost more than you projected, and some may cost less, depending on how you're negotiating. Huh?
Makes sense.
Yeah, yeah. Mm-hmm. Next, okay. Oh, wow. She put in a be more cooperative new development. Let's see what she's got here. Okay.
Before we move on, may I ask a question?
Go ahead. Please just ask questions, folks. You have to
I'm
ask,
curious.
just ask questions. I'm
Thank
here,
you.
Shasta. Go ahead.
I'm curious about in-kind donations, of time or of assets. That's been like a big thing for us, especially when accounting for like labor. It's been suggested to account it as both an income and an expense. Would that be true when using the GAAP method? Or should we just not account for in-kind donations in our budget?
Well, keep in mind about the gap method because you're talking about accrual. So say that we have board members and they all are contributing, say, 4 hours a month, right? And so if we're contributing 4 hours, say 4 hours a month, that's the in-kind contribution. So what I would look at that as, I would look at that not as liability, but I look at it as an asset, right? Because it's in-kind donations. So again, going back to your chart of accounts, you would have a chart of account that would say in-kind donations. And that's where you would record all your in-kind donations, either from board members or other volunteers. Now, those in-kind donations aren't being compensated because they're in-kind donations, right? So on your balance sheet, you make sure that you record them as in-kind donation, and then you accrue them as those hours are expended. As those hours are used. So if I don't use my 4 hours that month, then you carry that 4 hours off into the next reporting period. But as I use those 4 hours, then you give credit to those 4 hours in your balance sheet as well. Now, some folks, I've seen this as well, has used in-kind under revenue. Even though you're not paying for it, it's a cost that can certainly go to your balance sheet in terms of an asset. And so that requires that then you have to be able to give a dollar amount for that volunteer service. It's just not just saying Ron volunteered 4 hours. Ron volunteered 4 hours based on what hourly rate? You there, Sasha?
Right. Yes, I'm here. I was waiting for you to finish, and that's what we've done. But it ended up throwing off our budget because it looked like we had a lot more revenue than we had, and according to our board of directors. But from my perspective, I'm like, well, it's valuable. So how do you count it? So what we've done is like giving it a rate, like a dollar rate, and say, if we had 1,000 hours of volunteer hours and times the rate, then that's the value of the in-kind donation. But that's how we ended up with doing on both the expense and the income side of it, because while you want to account for it, you don't want to account for it and make it seem like you have more revenue than that.
No. I think if you put it in your line item as in-kind, and so whoever's reading that report will see that's in-kind. They know that in-kind is something donated. And so yes, it is going to skew your balance sheet and your income and expense statement, because you're going to see a line item that you're generating revenue on that you're not really expensing on the other side. There's no expense for in-kind. So you're going to have more revenue than expenses when you're calculating your income as a part of your revenue. So, but I'm saying that is not a bad thing, as long as you note on your budget that it's in kind. Now, I say this to say too, that many of funders do want to see what are your board members contributing to this effort. Sometimes it's in-kind monetary contributions, and sometimes it's in-kind time or other in-kind support they will give you. But you want to be able to record that. Are we there?
Yes, that makes sense.
Okay, all right. So yes, so again, let me just reiterate. When you have that in-kind contribution coming from the board members or other volunteers, record it as in-kind. You're not going to be able to expense it because you're not giving anyone anything for their time. They're giving time to you. So if you attach a dollar amount to what the hourly rate would be for the person doing that job, it's going to always show a positive side on the revenue side that you won't see on the expense side, because you're not expensing that. Versus if you had salaries, then you expense it because you're paying salaries out every week or bi-weekly. So that number goes down. But on an in-kind, no, it's a fixed number, and you only expense it on the revenue side and not the expense side. Okay, let's go through this initial session that this work exercise that Ms. Davis left us. So she said by the end of December, the cooperative had borrowed $1 million to develop its first property. And the development costs were $1 million. So they borrowed $1 million, and then the development cost to do this project was $1 million as well. Next slide. All right, here's the balance sheet. All right, land and building, that's the $1 million, right? Total asset was $1 million. Here again, they borrowed that $1 million loan. There's a liability now of $1 million. Total liabilities, $1 million. Equity, $0. Why is equity $0?
There's a synergist, I didn't know back then, but.
Ooh.
Hello?
Because it cost $1 million. I'm here because,
I'm hearing your background.
I was telling you because it cost $1 million. I was answering your question.
Okay,
and they had no equity in the building. I said they have no equity because they spent what they borrowed. And the building, like she didn't talk about the building if the building had equity in it or anything.
Right. So she's saying the building was $1 million, and that's what they paid for it. So it wasn't like they paid $1 million for a $5 million building, which would give them $4,000 equity. What they paid for is what they got: $1 million property, a $1 million asset, no contribution on the part of this nonprofit. So the equity contribution that you said was correct at $0. So the liability and equity right now is only $1 million because they made no contribution regarding this property. Now, if they had put $500,000 on the table, what would the equity have been?
$500,000.
That's great. That's so correct. Thank you. Next slide. The co-op had 30 units as was full to start the year. They had 30 units to start the year that were full. And so the number of members were assessed $1,000 each. All right. For a total of $30,000 budget. But 2 members did not pay the month, and 1 member paid the January and February charges. Okay. So there are 30 there are 30 members in this cooperative. 2 members did not pay, so instead of 30,000, we got $28,000 that was paid. And then 1 member paid January and February, which means they paid an additional $1,000 towards their payment. Let's go to the next slide. Okay, income statement following assumption 1. What the statement should be on the GAAP, the revenue again was 30,000, total expenses was 0, and net income was 30. All right. So that's on the GAAP, because again, what came in and what's going out. Here on a cash basis, the assessment was only 29, right? Because 1 person did not pay, so they only got 29,000. They had no expenses with 0, so the net income in this case is only 29,000. Do you see the difference? Again, the revenue under accrual was 30,000 that they projected folks to contribute, and they will record 30,000 in income. But on a cash basis, they only accrued 29,000 because only 1 member did not pay their $1,000, which means the net income was 29,000. This is a clear example on assumption of the GAAP versus the cash basis. So again, what they projected was 30,000, and that's what they recorded, the projection. But the actual dollars that came in were only 29,000. So on the cash side, you can see the difference of these two recording methods. Next slide, Michelle. Okay. So here are the, again, assumption following the number 1 regarding liabilities. Assets on the cash side was 29. The accounts receivable was 2,000. Land and building was 1 million. So this is the total asset. Remember, the land and building, the accounts receivable was 2,000 because remember, 1 member paid for 2 months, paid January and February. So that's where that $2,000 difference came in versus the 29,000 that was actually collected, which gave them 31,000 added to the building and land, which gave them a total $1,031,000. Here on the deferred revenue, we have $1,000. Why is it 1,000 under deferred revenue? Because somebody didn't pay, remember? Someone didn't pay their 1,000, so we got to put that under deferred revenue that's coming in later. So we added that 1,000 to our liabilities, which is again our building, which 1 million. It gives us $1,001,000. So our net income year to date is what? 30,000. Because again, we have the 30,000 that we have from the 30 members, 1,000 each, plus the additional 1,000 that will show up as deferred revenue when that past due member pays their $1,000 in.
I'm a bit confused because I feel like the deferred revenue is money that you're going to make, and then the liability is the money that you're going to have to pay back.
Well, the liability is what you have to pay back because you bought this building over here. So that's debt. The liability is the debt. The building, remember, they bought the building for 1 million. That
But
is
isn't the deferred revenue like negative debt since like somebody else owes you that?
Now say that again.
Isn't the deferred revenue like the person who didn't pay their dues is in debt to you?
Right. That's why it's called deferred revenue, because they are in debt to you, which means they're past due in terms of their membership of $1,000.
Mhm.
That's why it's deferred. So it's deferred because we don't know when they're gonna pay it back. They may pay it in the incoming month or 2 months from now. So that's why it's put on deferred. But once it's paid back, where would that $1,000 show up again?
In the
Assets?
Asset side. On the asset side, right?
yeah.
Right. So that asset will so it will show up here once it's paid. But until it's paid, it's looked at as deferred revenue.
Okay, but I thought the assets was the liabilities plus the equity. So if the deferred revenue is not
Right. It's the total liabilities and the equity. So here we are, all your liabilities on the left. Here's the total liabilities, which are 1,000,001 plus the equity, which is the net income of 30,000, because that's what you're getting up front. That's what you said that you're going to charge every member $1,000.
Mhm.
But every member didn't pay their 1,000. So on this side here, in terms of the liabilities, you're carrying that 30,000 as a liability, but knowing that you only collected 29 of it because 1,000 is still owed. That's why they added the 1,000 to 30. It's 31,000. That's why you got 31,000 now, because the 1,000 is still owed to you.
But so don't you add up the cash, the accounts receivable, and the total liabilities to get the total assets?
Well, the cash is I only collected 29 though. I didn't collect the full 30. So if I'm not collecting the full 30, I only record what I've actually collected in cash was 29. And then I have to move this other item over in terms of my bookkeeping ledger to say it's deferred revenue.
Mm-hmm.
That's what this is showing now. I've only collected 29,000, 1,000 becomes deferred revenue owed to me at some later point in time. My liabilities are this land and building, again, this 1 million. So my total liabilities, again, is the deferred revenue, which is 1,000 plus my 1 million gives me my total liabilities. Now, when I come down to my net income year to date, because I'm carrying net income of 29 in cash and 1,000 in reserved deferred revenue.
Mm-hmm.
You seeing that right here? That's all net income. It's just deferred revenue along with this cash revenue. That makes my 30,000.
Okay.
Because if that person had paid on time, it would have been 30,000 over here.
Mm-hmm.
And that wouldn't, and it would be zero over here on the deferred revenue side.
Oh, we can't see your mouse.
Oh, you can? Oh, you see? Okay, good.
Oh, now I can.
Okay, great. So yes, so you would see that here. This cash versus this deferred.
Okay.
So is it good to have people or have a lot of deferred revenue in your balance sheet?
No.
No, it's not. You really want to be proactive in making sure that you get that money collected. And it can show up as an asset versus deferred revenue. Now, if I was going to a lender, and this is all showing my balance sheet, and I showed a lot of deferred revenue, that would be problematic. Because it showed that a lot of my equity is tied up in deferred revenue. Excuse me. Okay, let's go to the next slide. Okay, that was assumption 1. Assumption 2 is also in January, the co-op purchased of $5,000 worth of supplies for which it paid $4,000 by the end of the month. and the staff incurred 8,000 wages for which they paid 7,000. So, excuse me. So I think based on what we just the exercise went through, I think we see now what's going on here. So let's go look at the next slide. Okay. The same similar situation. We have supplies down here that we purchased for 500, but we only paid 4,000 towards. So we have a difference of $1,000 here in terms of deferred expense, because we still have $1,000 that we've not expended. We only expended 4,000 of the 5,000 in our budget. And this is where the example of the variance comes in, because if we had a third column here, this 1,000 would show us the difference of our expense versus our revenue, and it would show $1,000 to a plus that we still had left to expend. And the same shows true with wages. We had $8,000 for wages, but we only paid 7,000. And again, we have another $1,000 out there in terms of variance. So when you look at the bottom line here, we have $11,000 worth of expenses that we've incurred in terms of supplies and wages, but we again had budgeted 13,000. And the bottom line is that net income on the GAAP side is 17,000, and our net income on the cash basis is 18,000. So again, when you're sitting down and you're looking at these budgets, looking at actuals, projected, the differences in terms of variances, and how you're recording them basis the GAAP financing method or the cash financing method. So next slide, Michelle. Well, again, looking at this here, accounts receivable 2,000. Now, why is account receivable 2,000 here? Because we took 1,000 out of the supplies and plus 1,000 out of the we accounted for 1,000 out of supplies and 1,000 that we counted for the employee salary. That was receivable of $2,000. And it's the same carrying over on the other side of our ledger in terms of what is payable. We still owe another 2,000. And again, this is the 1,000 that we had originally from our deferred revenue from the members not paying. So we now have accumulated $3,000 of deferred revenue, either through accounts payable or deferred revenue. $3,000 that we've not collected on, that we add to our balance sheet. Again, going back to the scenario, the $2,000 that we accrued because we didn't pay $1,000, paid $1,000 less on supplies and $1,000 less on the salaries, which came up to 2,000. And this 1,000 what we deferred already because one member had not paid their total dues for that month and had put him off paying later. So that was $1,000, which totals up to $3,000 in terms of this revenue that we've now have accrued over period of time. So when we look at our total equity, which is here 1,020, why do we have 1,020 here as a total liability equity? Because again, this is what our year-to-date income is right now. Again, our year-to-date income is 17,000 because we only got 17,000 from cash because we deferred 1,000. And so this, again, coming down to this line item, our net income year-to-date is 17,000. So again, as founders, and probably most of you will probably be the original board members of your organizations, understanding and reporting, your financial outlook to your membership becomes very critical and important, that you read these reports and that you interpret back this information to members of your co-op. Next slide, Michelle. Okay, assumption 3. Also in January, the co-op made a loan payment of $3,000. 2,000 is comprised of interest and 1,000 paid down the principal balance. Let's see how she worked this third assumption here. Next slide. Okay. Again, we're going down to the gap side. We're looking at the $30,000 in assessment that we got from the 30 members and 1,000. We look at the 5,000 that we paid towards, that we allocated towards supplies, the 8,000 that we allocated towards wages, and the interest that we're paying on that loan, which is 2,000. So our total expenses is 15,000. We look at the 5, the 8, the 13, and add the 2, it's 13 total expenses. And our net income is $15,000. Why is our net income 15,000? On the gap side, does anybody see that? See why it's 15,000? Because we had 30,000 of assessments, we minus out the 15 for our expenses, so our net income on this gap side can only be 15. There's 15,000 here. We've paid these expenses out of this 30. We're billing it to the 30. Not that we paid it out, but we're billing it to the 30. So that gives us net income of 15,000. But when we look at what we've done actually, we only collected 29,000. Remember, there's one member who didn't pay the 1,000. Remember that we've only paid out 4,000 of the 5,000 for supplies. We've only paid out 7,000 of the 8,000 for wages. And of the mortgage interest, we're slated to pay out 3,000 as opposed to 2,000 that we're budgeting. So when you look at these costs here, the 4,000, the 7,000, the 3,000, we get $14,000 of total expenses of those line items, minus our total assessment that we collected was 29. At the bottom line, our net income on the cash accrual basis is $15,000. So when you're ever thinking about deferring payments, making sure that on the ledger side that you're noting that the partial payments that you're making versus the full payment that you're making, particularly when you're using the cash accrual basis versus the gap basis. How would this scenario work out if you were buying? Sienna, I'm going to ask you this question. You're a farmer, you got to buy seeds, right? And so you say that you want to buy some seeds and you don't pay for them all. How would you record that here in a financial statement?
Would you list what you purchased and If you didn't buy them all,
Well, if you didn't pay for no, you bought the, say the seeds cost me 100,000 or maybe 50,000 or $50. I've only paid 30,000, 30 of the 50. How would I carry that on my books?
is that a deferred payment, a later payment that you're gonna invest in?
That's right. It's just like here. Even though it may have cost me $50 for the seeds, I've only paid 30. So what am I carrying on this side here? I'm paying to carry another 20, right?
Right, the remainder 20, right.
Right. So keep that in mind as you structure your budgets in terms of knowing the difference between accrual and GAAP and how it shows up. Okay? And that's for all of you in terms of just looking at, again, looking at your projected, looking at your actual, and then coming up with your variance. And so as you go forward, looking at your budgets, I'm suggesting that you set up a column for your projected budget for your organization. If you start to expend money now, you can start tracking through your receipts, what you've actually expended, and then come up with your last column in terms of your variance, in terms of what you are looking at in terms of the difference of the two. So I think Miss Davis will be very proud of the fact that I've been able to communicate this to you, hopefully, in a way that you can apply it in real life scenarios. Next, okay. So again, let's look at this balance sheet, how it's structured. Again, the $15,000 was in net income, remember? The 2,000 receivable, and the 1,000, so that was the total assets under this GAAP assumption. And accounts payable was 2,000, the 1,000 deferred for and so we decreased the liabilities to 999 because what did we do? What did we do? Why is this down here?
Because you paid $1,000 off the mortgage.
Off the mortgage, right? Yeah. Yeah. Next slide, Michelle. So she asked a few financial statements. Are revenue and expenses expected to be consistent all throughout the year?
No.
Right. That's why you want to do the variance. So you can track the inconsistencies from previous years. So variances are really great when you're looking at doing trends. And why are trends important?
So you can see what's selling and what's good and not. I mean, it depends on what you're doing.
And it lets you be able to do a comparison on your budget through time. So yes. All right. So I do believe this is the last slide. Yeah. I love that. None of us is as smart as all of us. That's so true. So let's entertain some questions and dialogue regarding what we've covered thus far in terms of our knowledge around the various different accounting systems, the accrual, through GAAP and the cash system. Now the question becomes that I would ask you, what system would you consider would be best served for your group? Any comments? Well, of course, if you're in a cash business, when you're in a cash business, probably the cash system would serve you well if you're in a cash business, where you're creating revenue and then you're creating expenditures almost simultaneously. But if you're looking at payment over time and collections, then of course, the cash system doesn't work best in recording and documenting that. And so if you're looking at purchasing product over time and paying for that product over time, or hiring staff and paying them over time, then certainly you want to be able to put yourself in line of doing the gap method of record keeping for your organizations. Now, let me ask a question. How many right now do have accounting systems in place? Did I ask that question earlier? Does everybody have one in place or not have one in place? Okay. What happened? Did anybody go to sleep on me or what? All right, let me stop this camera here for a second. All right, Michelle, you can close the camera and stop viewing. Let's see where we're at. Okay, so I asked a question about, have anybody gotten to this point right now and you begin to consider setting up your accounting systems? How about you, Patrick? You've been in operation for a while now. Are you incurring expenses right now?
Yeah, we log them in a sheet or whatnot, and we have them logged in a Excel sheet.
Okay, then, okay. But you're not set up an actual chart of accounts yet?
No, not an official one. We don't have like, I don't know, one of those systems yet, like a digital.
Okay, all right, okay.
But it's not a heavy, it's not a cost heavy, because it's more of like, it's on the internet, it's digital, and it's scale. But yeah, it's something we need to do.
Thank you, Patrick.
Yeah.
Thank you, Patrick. I like that. I like that response. Something that you need to do. Yeah, yeah. Someone just said something in the chat. Who was that that just shot me a message in the chat?
That was Shioma. I was just saying, answering the question.
Go ahead.
Yes, I mean, yes, in a general sense, because they're entities leading into the cooperative, but like, in our one-on-one, we're just spanking new on the cooperative itself, but the infrastructure that will support creating it is being accounted for.
Okay, so you mentioned you have accountant, but not yet a bookkeeper.
Right.
Okay.
Right.
And you know the difference between the both of those roles, accountant and a bookkeeper?
Yes, I think so. I mean, the accountant supports in the filings and in the fiduciary like responsibilities around the accounting of the business, and the bookkeeper kind of supports with all the detailed things we're just talking now, where we place our assets and our expenses. And
well, yeah, your bookkeeper is going to be a person who's going to do your day-to-day in filing of your expenses and your revenue. And your accountant is a person who goes up a little ladder in terms of being able to also be able to come in and certify the work of your bookkeeper. And that's what the accountant's going to do. They're not going to do your bookkeeping, but they're going to certify the work of your bookkeeper and the chart of accounts. And then they can do also other things like audits and compilations for you, things of that nature.
yeah, I mean, things are so small scale in the moment that I do the bookkeeping myself, but as the nonprofit kind of kicks off, we have to create those independent processes.
Okay, so I'm gonna just piggyback on Shama, what you just said in terms of small. Prepare for growth. As you start to develop your ideas around growth. That where you are today is not where you will be 3 months from now, 4 months from now, 5 months from now. Because if you're there If you're in the same space you are now, 4 months from now, then I would begin to question some things. So look at growth. Look always down the road of growing and preparing yourself for the opportunity, because you never know when the opportunity will knock on your door. And if you're prepared, then you can seize the opportunity. If you're unprepared, then you pass the opportunity on to the next person who's prepared. Because you never know when opportunity knocks. So just make sure that you're prepared to receive when it does. One of my
Yes, absolutely, absolutely. Thank
Yeah.
you for that.
So, so with this presentation, it was sort of giving you an overview. Didn't want to make any accountants or bookkeepers out of you, but certainly letting you know that this is information that you need to be able to incorporate in the work that you're doing. Having an understanding of the finances. As I said earlier, one of the things about governance is that it becomes your responsibility to make sure that everything that comes across for your decision making is being properly decided on and that you're properly reporting on. All right. So next week, I'd like to be able to, I'm going to have Michelle send out to you, and I want you all to send me by next week a budget. I want you to sit down and send us a budget by no later than next Tuesday. Michelle, make a note of this. I want to see what your thinking is around your budgets. So send me a budget. We'll send you a spreadsheet to do that on. And I'll send it out. I'll just give it to Michelle to send out, and you'll get a chance to construct the budget, and we'll do some walking through next week on the budget. Okay. All right. I did go through the checklist, and I'm gonna for those of you who have not scheduled a time to meet with me, I like to be able to schedule as soon as possible, because time is really going really fast with regards to this this academy. We're now in week 2 already. We have 4 more weeks to go. And I see Sienna yawning there, I understand. So let me just review a couple of things that we've not gone over, and I will be sending you out. When we talked about governance last week, we didn't talk about how to run a meeting. Do all of you know how to run a meeting? I know you attend meetings, but do you know how to run a meeting? Shaking heads? Okay, all right. Everybody knows Robert Rules of Order. You, Patrick?
I've participated in them, but I don't necessarily know if I know them.
All right, I'm gonna send you a handout that'll help kind of guide you through this Robert Rules of Order, because keep in mind, folks, I keep saying this here, and I will keep elaborating on, you are the founders of this organization that you now are starting. And if you plan on bringing in other people, your knowledge base has to be to a level, what you don't know, you have to be able to direct people to, because they're going to be expecting you to know. And so they're going to ask you questions about governance and things of that nature. So I'm going to send this Robert Rules of Order to you. I'm going to also, and Michelle has already did this, already sent to you to the Cooperative Business Ecosystem. I'm going to talk a little more about your surveys, and I'm going to have some real intentional questions to talk to all of you about, as we do the one-on-one. We'll make sure we get these budgets up and running. And Michelle, who's our next presenter next week?
For the business plan, I think it would be you, and then for next Thursday, it's going to be Jessica, James, and Mark.
Okay, so, all right. So we'll be sending some documents to you. And so I wanted to, because we're a small group, I wanted to make sure that we get some of these documents returned so we can have some healthy discussions around them going forward. All right. So it's going to be homework time, folks. So I'm going to make sure that that as you proceed forward, that there's some things that you've gotten out of the way, that you have gained some knowledge around going forth. Right. Any questions out there lurking that about anything that we covered thus far up to date to this fourth session? Well, how are you feeling right now? Are you feeling that you're growing in this space to understand what's being required of you?